Hello everyone, this is Marshall aka the ThetaTrada, and in this video we're going to be talking about the poor man's covered call. I would highly suggest if you haven't seen my video about leaps that you pause this video and go watch that one. It should be dropping alongside this video. And the reason for that is we're going to be purchasing leaps as part of the poor man's covered call strategy. So if you want to know all the advantages that leaps brings, aside from buying 100 shares, I'm going to link that somewhere in one of these two corners and go check that out. Like I said before, we're going to be going over the poor man's covered call in this video, and we're going to be talking about how it's different from a normal covered call, what are the benefits we could take advantage of in using this strategy, how to track the profit and loss of a poor man's covered call, and we will also be going over a real world example of a good poor man's covered call trade where we win a lot of money and a bad one where we actually lose money. If you like this video and you want to see some more of my future content, I highly suggest you subscribe. I try to put out 2 videos a week. I'm thinking now that the 2 videos will probably be going out on Friday or Saturday. I'm still kind of messing with that schedule, but I should be dropping 2 videos on either one of those days. It looks like this week it's going to be Saturday. So with all of that, let's get right into the video. Alright, so let's get to start talking about why the poor man's covered call is probably the best options trading strategy that there is out there. So first, let's do a recap of what a covered call is. So a covered call, if you remember, is where we own 100 shares of a stock. We put those 100 shares up as collateral in order to sell a call that we don't already own. And because we're selling an option, we get to collect the premium from selling that option to the buyer of the option. If the short call expires in the money, we sell our 100 shares to the buyer at the strike price. And if the short call expires out of the money, the call expires worthless and we get to keep all of the premium given to us by the buyer. So if you look at the difference between a covered call and a poor man's covered call, so the main difference is the collateral that we have to put up in order to sell that short call. In a poor man's covered call, we will be putting up a long call as collateral, and usually this is going to be a leaps call. And again, if you haven't seen the video about leaps, pause this video, go watch that one. It's linked. It's also in the knowledge base playlist. So we are able to put up a leap call as a collateral because the leap is in the money and it can be exercised at the time our short call expires in case we need to provide the 100 shares to the buyer. Now, if that doesn't make sense, it will in just a little bit when we go over our real world example and everything like that. So if that was kind of confusing, just bear with me and watch till the end. So let's go over the benefits of a poor man's covered calls. So the main benefit is the fact that any short call that we write essentially is a hedged bet against the leap. And since we are long and short on the underlying, we could take advantage of positive and negative delta, theta, and vega. So if the underlying is going up, obviously our short call is going to be losing money, but our long call is going to be gaining money. And the hope is that we'll be gaining more money than our short call is losing. Again, positive and negative theta. Our long call is going to be losing money as time goes on, but our short call is going to be gaining us money as time goes on. And vega, if the implied volatility goes up, our long call will be worth more, but our short call will be worth less. So the goal is to sell far enough out of the money to where the negative delta from our short call is outweighed completely by the gains of our long call. So let's go into calculating the P&L or profit and loss of a poor man's covered call at expiration. So this is going to be taking S sub 2, which is our short call strike, minus our S sub 1, which is the long call strike, plus any credits, and credits is just money that you gain from any premiums that were received from the short call, minus any debits. So the debits could be the cost, the initial cost of getting into the long call in general, or if for some reason we get into a bad situation, we have to roll out one of our short calls for a debit, that would be subtracted from this whole equation. And then we're going to multiply all of that times 100 to figure out our profit and loss. So let's get into the real world example. Don't worry too much about this equation because we'll be going over this in a spreadsheet that I created. So in here, let's pretend that we're going to purchase a long call, and we purchased it yesterday, which was, let's say, end of day yesterday. And our long call, our leap, is going to expire January of 2022. Our long strike is going to be $10, and the cost of this $10 strike is $1,988. So I actually got this from looking at Palantir. Palantir is actually really hot right now, so I went to the January 2022 expiration date. I picked this $10 strike, and it's worth $1,988 right now. This is actually a leap that I own, so I just wanted to throw that in there as well. So that's where I got those numbers at. So here we're going to, another important thing to keep track of is our long cost basis, our break-even stock price, and we get the break-even stock price by taking the cost that the long call cost us, and then also the addition of what we're going to have to buy those shares at expiration. And then we're going to see the profit from premium. So any short call that we sell against this is going to net us some premium. So that's just going to be the sum of this column right here. The cost of the long call, which is the debits. So this is going to be the cost of the long. And then our total profit from the trade. And we can see the total profit from the trade right now is almost minus $3,000. So that's going to be the cost of buying 100 shares at this $10 strike. So that's going to be $1,000 plus the cost of our long call right here, which is $1,988. So that's how we have this initial profit from the trade of minus $3,000. So let's go and just simulate this trade right here. So let's go to March 19th. We're going to be selling monthlies against this. And we can see that at the 0.3 delta, this one's 0.33, this one's 0.3. So let's say we're going to average around $200. It could be more, it could be less, but let's just say we're going to average about $200 per short that we sell against this call. So let's say the first time, now the reason that we want to keep track of this break-even stock price is that we never want to sell a short strike that is under this break-even stock price, because if we do that, we're taking a loss on the shares and possibly a loss on this entire trade. So that's why this break-even stock price is really, really important. So let's say at first, Palantir's trading at 29. So let's say we sell, what was that initial one that I saw? Let's say a 37. So we'll sell a 37 strike against this, and again, we're going to collect roughly $200. So if we enter all that in, we can actually see that the long cost basis was subtracted by $200. Now it's $1,788. Our break-even stock price dropped by $2 a share. So now our break-even stock price is $27.88. We can see that the profit from the premium increased. So now we have $200 in profits in there. Cost of the long call, that's always going to be $19.88. And our total profit from the trade, instead of being almost minus $3,000, is now minus $2,800 basically. So let's just say that we keep on selling. It's pretty much flat this month, so we'll sell another 37 the next month, and we'll gain another 200 from that. So again, everything's getting less and less except for the profit from the credits. So this is now at 400. Now let's say that at this month, Palantir is trading at like 35, so we'll sell a 40 against it. Again, another $200. Then let's say it's close to like 39, so we'll sell a 45 against this, another $200. And again, this is each month going by, so we're getting monthly $200 off of this initial $1,988 cost. Now let's say this month we sell a 45 again, but let's say, and we gain our 200. But let's say this month we actually let this long call expire. And so what that's going to mean is that Palantir closed above this $45 strike. So let's say it closed at 46. And this long call got exercised to cover our short call. So our long call is going to get exercised. We're going to buy 100 shares of that stock. And then our short strike, we're going to immediately sell the 100 shares we just bought for $45 a share. So that's how we get this total profit from the trade as $2,512, because this is going to be A9, which is the cost. Let's see if it highlights everything. Okay. A9, so this 45. So if we look back at our calculation here, this S sub 2 minus S sub 1, this is basically just the width of your strikes. So if we look at, if we look at 45 minus 10, the width of those strikes is 35. So then we look at plus credits. Plus credits. So we had $1,000 in credits. And then we also subtract our debits. So we had a 1,988 debit. And when we multiply all of that by 100, we get $2,512 total profit from this entire trade, which is crazy good. I mean, if we just bought 100 shares and then sold it at the 45, again, this is trading at roughly $30 right now. So if we bought at 30 and sold at 45, we would only be making $1,500. So the difference is we made this $1,000 in profit. So that's why the poor man's covered call is awesome, because you get to basically own 100 shares of the stock for a lesser price, which is what the leap is doing. But then we can also sell short calls against that and collect premium from our long call. So that's why this is amazing. Now let's look at, so this is like a good example of a poor man's cover call trade, but let's look at a loser. So again, we're going to look at the same Palantir long call, a $10 strike, 1988 price and everything like that. Our total profit from the trade again is, minus 3,000 to begin with. But let's look at something that would be a loser, or how you could lose from this trade. And basically how you lose from this trade is not watching this video and knowing to keep track of the break-even stock price. So let's pretend that someone hasn't watched this video and they don't know to keep track of this break-even stock price number right here. So let's assume for the first month, everything is going super, super well. They sell the 35 strike like we did before. They collected their $200 in premium. Everything's great. And let's say the next month again, stock price keeps on going up. They sell the 40 for another $200 in profit, right? But let's say on this one, this next month, something happens with Palantir and it's falling. It's crazy down. Let's say the stock price is trading at around $15 a share, right? So this person's panicking. Holy cow, my long call is losing me so much money. Like, yeah, I gained the $200 from selling this short call at 40, but now my long call is losing me insane money. And let's say that they don't know to keep track of this break-even stock price. So the next thing that they do is sell a 20, because that's the 0.3 delta that we should be selling at anyway. They gain 200 from that, but then guess what? They sold below their break-even stock price. Hold on, let me put a 0 in for this. Let's put a 0 in for this as well. Let's pretend we haven't done that yet. They sell below this break-even stock price. So in order to break even on this trade, we would have to sell above 25.88. But they didn't know any better. They sold the 20, and they got $200 from doing that. But we can see that we actually lost money on this trade. And it's going to be the difference between the final strike that we got assigned at and the the break-even stock price. So we lost 388, which was $3.88, but that's per share. So we lost $388 from this entire thing. Now, the reason that somebody might do this is, one, people don't know to keep track of the break-even stock price. Two, you sell the short call and you forget about it and it gets assigned without you even realizing. Three, if we're looking at always selling at the 0.3 delta, let's say you do know to keep track of this break-even stock price, but when it's trading at, let's say 30, let's just take this example right here. Let's say it's trading at 30, but your break-even stock price is like $50 or something like that. Somebody might get greedy and say, well, I don't want to make $61 this month. That seems like a long time to wait for just 61 bucks. I'm going to sell something closer to the share price so I can get that full 200 or get this, even more than that, get 230 or 250 bucks. So that's another reason why people might get into the sticky situation of not selling above the break-even stock price and really putting themselves in a bad situation to lose money off of this trade. Or like I said, they just don't know to keep track of this break-even stock price. All right, so that is really all there is to know about the poor man's covered call. I am in several poor man's covered call trades at the moment, which you can see which ones I'm in the spreadsheet linked in the description. So I'm not just giving you guys useless information, and I'm not bluffing about how all of these things work. Like, I actually implement this trading strategy all the time. I'm currently in like 4 or 5 poor man's covered calls at the moment. So if you guys want to check out which ones I'm in, again, check out the spreadsheet in the description. I update it all the time with what trades I'm actually in and how those trades are doing. So if you see me losing money, I'm very open about that. And if I'm gaining money, I'm very open about that too. So again, just check the spreadsheet down below if you want to see the poor man's cover calls that I'm in or how those trades are even doing. I hope some of you take this knowledge and get into a poor man's covered call trade of your own, and if you do, let me know down in the comments. I would actually really like to see that. And if you want to know some of my stocks about, or want to know some of my thoughts about the stocks that you're thinking about trading poor man's cover calls on, or have any questions, again, ask them down in the comments, and I'll be happy to answer. I'm not a financial advisor, but I'll let you know what my thoughts are. Like I said, please like this video and subscribe to the channel if you want to see more of my future content. I have a lot of ideas for this channel coming up in the future, so if you'd like to see all that, please subscribe. And with that, I'll see all you guys in the next one.